Number 1 is VFV. The Vanguard S&P 500 Index ETF provides exposure to the US market. Number 2 is XIC, the iShares Core S&P TSX Capped Composite Index ETF, and that covers the Canadian market. And number 3 is XEC, the iShares MSCI Emerging Markets ETF, and that offers access to international growth opportunities. All right, in this video, I'll break down each ETF and explain why they're such great investments in 2025. I'll cover their expense ratios, historical returns, top holdings, and how they fit into a solid investment strategy for your TFSA and RRSP accounts. Let's start with my personal favorite, VFV. VFV is the Vanguard S&P 500 Index ETF, and it is a must-have for Canadian investors. With an expense ratio of just 0.09%, you're paying only 90 cents per $1,000 invested each year. It's designed to track the performance of the S&P 500, which means you're investing in the 500 largest US companies. And over the last 10 years, the S&P 500 has delivered an average return of about 11%. So if you invest $7,000 today and contribute $7,000 annually, by the time you hit 30 years, you could have over $1.7 million. That's the power of compounding interest. And I put a link to this investment calculator and other helpful tools in the description below. And you can say thanks by hitting the subscribe button and like buttons. So why is VFV my favorite? Well, it gives you exposure to the S&P 500, which includes some of the most influential companies driving the global economy. The top 5 holdings include Apple, Microsoft, Amazon, Nvidia, and Alphabet, Google. And a common question is, why not just buy VOO, the US listed version of VFV, since VFV simply just holds VOO? The main reason is that VFV is Canadian denominated, allowing Canadians to avoid the 1% to 2% currency conversion fees and fluctuations associated with buying VOO in US dollars. While VOO has a lower expense ratio of 0.03%, these savings can be offset by the currency exchange costs. And I've primarily owned VOO in the past, using a time-consuming method called Norbert's Gambit to minimize currency exchange fees. However, moving forward, I'm purchasing VFV to simplify my portfolio. In 2025, I plan to focus on real estate investments, and I need to free up mental bandwidth to learn about rental management as a novice. So switching to VFV eliminates the need to manage currency exchange, providing the same S&P 500 exposure with less hassle. All right, now let's talk about XIC, the iShares Core S&P TSX Capped Composite ETF. This ETF gives you exposure to Canada's total stock market with an expense ratio of just 0.06%. And over the past 10 years, it's delivered an average return of about 8%. So if you invest $7,000 today and contribute $7,000 annually for 30 years, you could have around $925,000. XIC helps diversify your portfolio by adding exposure to the Canadian market, which is important for supporting local industries. The top 5 holdings in XIC are big names like Royal Bank of Canada, Toronto Dominion Bank, Shopify, Canadian National Railway, and Enbridge. XIC also offers a dividend yield of about 2.5%, which is higher than VFV. While its performance isn't as high as the S&P 500, it gives you good Canadian market exposure, particularly in the financial and energy sectors. Finally, let's look at XEC, the iShares MSCI Emerging Markets ETF. This ETF focuses on emerging markets, sort of like this emerging YouTube channel. So remember to hit subscribe to watch my weekly Canadian investment videos. All right, XEC gives you access to fast-growing economies around the world, and it has an expense ratio of just 0.26%. And it has delivered an average return of around 7% over the past 10 years. So if you were to invest $7,000 today and contribute $7,000 annually, after about 30 years, you could have around $760,000. XEC is a great way to diversify outside the US and Canada, with exposure to countries like China, India, Brazil, South Korea, and South Africa. The top 5 holdings in XEC include Taiwan Semiconductor Manufacturing, Tencent Holdings, Alibaba Group, Samsung Electronics, and Reliance Industries. And while emerging markets offer high growth potential, they also come with higher risks, like currency fluctuations and political instability. But adding XEC can balance out a US and Canadian heavy portfolio. So a safe, balanced allocation could be 50% in VFV, 35% in XIC, and 15% in XEC. However, if I were starting out today, my personal split would be 90% in VFV, 5% in each XIC and XEC. I'm more bullish on the US market and less optimistic about the future returns in the Canadian and international markets. That's just my own personal preference. In the end, no matter which split you choose, you're still going to end up with over $1 million after 30 years. Now, here's what my TFSA portfolio looks like in 2025. 50% in VFV/VU, 2.5% in XEC, 2.5% in XIC, 10% in VUG, and 35% in specific stocks. A question I will most likely get is, why do I keep VUG in my portfolio? Well, that's because VUG, the Vanguard Growth ETF, has been a great performer in my portfolio. It focuses on US large cap growth stocks, and its expense ratio is just 0.04%. Over the last 10 years, it's delivered an average annual return of around 13%. That being said, I'm not adding more to my VUG position in 2025 since I am moving away from ETFs not listed on the Toronto Stock Exchange. But I'm not selling it either. I bought in at a good price and I'm pleased with its performance. I'll keep it to continue benefiting from its growth potential while maintaining a simple overall strategy. And to learn more about VUG and other US stocks I own and how they fit into your RRSP and TFSA, check out last week's video in my description. All right, so my goal is to make my TFSA as hands-off as possible, but I still have to actively manage part of my portfolio through my individual stock holdings. And if you'd like, I can create a video explaining how I choose those stocks, the ones that I believe will outperform the S&P 500, and how I choose entry and exit points. And even though I might make a video about it, I still don't recommend picking individual stocks, especially if you're new to investing. It's rare for a single stock to outperform a broad market ETF like VFV over the long term. Stock picking requires extensive research and can add a lot of volatility to your portfolio. And when I started, I only allocated $2,000 to individual stocks. Everything I've invested beyond that has been profits from that initial amount. So it hasn't impacted my ETFs or my retirement plan. It's essentially extra, allowing me to take riskier and riskier investments. So if you are serious about growing your TFSA in 2025, consider these ETFs: VFV for US market dominance, XIC for Canadian exposure, and XEC for global diversification. And remember, consistency and time in the market always beat timing the market. All right, bye guys.